Welcome in, welcome in. All right. So looks like we have about 300 of you guys in right now. Gonna make sure everybody saw this. And this is recorded too. Okay. Yeah. Just share screen. Everybody can see Safari. Awesome. Okay, cool. Is my voice low? Is it better now? Is it better now? Can you guys hear me? I'm on a completely new audio setup, so hopefully it's better. Just on a different setup right now. But okay, so in today's session, I wanted to make today very open-ended because we've done a couple classes so far. We've done supply and demand, we've done risk management, we've done trading breakouts, and I kind of realized that every session we've done so far, I've ended the Q&A. I literally just stopped the session and said, "Okay, bye guys." And I wanted to make today very open-ended so that we can go in any which direction you guys want. Then we're going to reconvene on Friday, and we're going to have a real official lesson. So Friday we're going to have like a real lesson where I have a actual PowerPoint in front of you all, like we usually do, because every time we've done lessons so far, we've had like real PowerPoints, stick to the script, right into it, and it's usually about 30 minutes to an hour, usually about an hour. So on Friday we're going to have that. So we're going to have one of those big sessions. I know you guys love that, so we're going to do that. But today's session is going to be literally covering any topic you guys want. So if you say, "Listen, Brett, I liked your supply and demand lesson, but I still don't understand this concept. Can you go over supply and demand one more time?" That's what I'm going to do. I'm going to spend 5 minutes going over that. Then I'll spend 5 minutes going over something else you guys want me to go over. Or you could say, "Hey, I want you to go over this ticker. Can you go over this ticker and tell me everything you know about it, and chart it from start to finish?" Whatever you guys want to do is what I'm going to do. So that being said, what I want you all to do is I want you to use the Q&A feature. So I don't know how to do it on your end. Unfortunately, I don't know how to do it, but I want you to use the Q&A feature. If you can't use the Q&A feature, you can use the chat, but I'm going to prioritize the Q&A feature. So over the next 45 minutes, 30 to 45 minutes, I'm literally going to go from question to question, going over the answer. That's my game plan. It could be trading related, it could be chat related, it could be market related, it could be anything that you think I might have some insight to. That's what I want to do. That's what I want to do. So type a question in and we'll get started. So right off the bat, Alicia asked a question. Where did it go? Please go over supply and demand. So what we're going to do, we're going to go over supply and demand, how to manage a losing trade / taking profit. Yeah, let's do that. So what I want to do, I'll move my stupid face to the right. What I want to do is I want to go over two charts with you. I want to go over my trading day from Friday. So Friday, my game plan was to trade two things. So really was to trade Tesla and Amazon. My main game plan was Amazon, off this 140 bounce. This was a winning trade, right? And you manage a winning trade the same way you would any other trade, repeatable action. So what I did here at Amazon was with every bounce play I trade, if I'm watching a 140 bounce, well, what I'm going to do is I'm going to start scaling it a little bit earlier. So I used about a 50-cent margin on Amazon, and I started scaling in as soon as it ticked red into my 140.5. So this candle, I started buying calls in. I then made one more add at 140. So I had about 30 contracts in total. Horrible handwriting here, but I got 30 contracts in total. And what I did here was I broke this up into two orders, 15, then 15. And the reason why I do that is because I'm dollar cost averaging into this trade with the intention that it's going to hold 140 and bounce off of it, right? Now, if this worked out poorly, what would have happened was we would have won 140 and then we would have lost 140, and I would have given it probably about a 20-cent margin which is a little bit of an ATR candle, which is a volatility candle, underneath my balance level, which is 140. So about 139.80, right? That would have been my stop loss. And I would have just left it there and probably taken maybe 10 to 15% loss. In this case, the trade worked out. And how did I manage this trade? Well, very simply, all I did was I got 15 here. Then I bought 15 more right into my key level, which is what I always do with bounces. Then as soon as we started ticking higher into the previous structure, I sold another 15 here. Then I sold 10 over here, and the rest I sold into this consolidation because it simply just was not going for me. So this is how I manage a winning trade. What I do is I scale in and I scale out. With every trade you take, and I know many of you guys trade different accounts. Some of you guys trade big accounts, some of you guys trade small accounts. The best way you can be, the best thing you can do if you're a small account or a big account is learn to scale in and scale out properly. Because I'm telling you this was one of the biggest things that shifted me from being a profitable trader versus an unprofitable trader. I literally tried trading one contract at a time for 3 months, and I was literally break even almost every single day. I'd be up, $20. I'd be down $30 the next day, up $40, down $45 the next day. And I realized what was the issue for me was that I wasn't allowing myself to get those very big wins, because what would always happen is I would take profit at 20% into a structure point like this, but then I never would have contracts to run, to let go. So one of the things I did was I maxed my lowest position was 3 contracts, meaning on every trade, I would have 3 contracts. I would buy one off the get-go, then I would leave 2 more average downs to get into the position. And then just like you scale out, just like you scale in, you also scale out. So if, for me, for example, right, this trade, even though I sold some here and I sold some here, and then I sold some here, what would have happened is if we cleared above this and maybe retested that and saw a big push higher, this could have been a trade that was, a 200% plus trade or 100% plus trade. It wasn't, right? It wasn't, but I put myself in the position to allow for that to happen. Now, granted, it didn't happen, but it still was a net green trade. And I gave it as much time as I possibly could, right? Whereas here's another trade, right? This is my SPY trade from Friday. This was a pain in the ass trade, right? It was a trade that had taken forever, but I started scaling in calls over here. I added more down over here in the second red candle. Then I held through consolidation for almost 2.5 hours, which is unusual, but it kept me in because it was above my stop loss. Then this was my stop loss initially, right? Then as it sort of pushed up higher, right? As it pushed up higher, I then scaled out at break even. Even though I was break even on this trade, I still scaled out a little bit here so I can lock in a little bit and reduce my exposure. Then once we broke below here, which was sort of a little bear flag, I then sold the rest and got out for a losing trade. But that's how you manage a winning trade versus a losing trade, is you're just scaling in, scaling out, right? And I think the best thing you can do as a trader, early on, is learn that every profitable trader I know has some sort of scale in or scale out method, right? It's almost impossible to come in and just buy full size and then sell full size every single time, because you're not giving yourself the potential to take safe sells, and you're not giving yourself the potential to get those larger percent wins when it does work out for you. That makes sense. Hopefully that helps. Okay, let's review some other questions here. Guys, people who are just joining in, remember to use the Q&A feature, and I'm going to be going over everything in the Q&A session. In the Q&A section, I'm going to try to get through. Right now, there's 67 questions in here right now. So I'm going to try to pick the ones that I think are most applicable to you guys. Okay, so we already answered this one. So we answered that one. And then we did that run. Let's go over how do you can you go over making your charts? Yeah. So this is my breakdown of how I use TradingView. So what I do every single morning is I run through a top-down analysis. This is very important, right? There's a lot of people coming in with supply and demand questions. I'm going to go over it very quickly. Let's go over a ticker. Let's go over a ticker that you guys want to go over. Type in a ticker in the chat, and we're going to chart it from start to finish. Type of ticker you guys want to go over, and we'll use that as our ticker to trade. Amazon. Let's do Amazon. Yeah, let's do Amazon. Let's reset this whole thing, and let's let's actually chart this, right? So what we do with every chart is I usually start off in the daily time frame. And what I'm going to do is I'm going to identify any key levels that appear to be very well respected. You guys know that there's two things I look for when it comes to supply and demand. I look for respect and I look for impulsive moves. Two things, respect and impulsive moves. In this case, we can see here, we have a big level at 146.50, right? On the daily time frame. You can see it. Big impulsive move down off that level. We also have respect over here. So I like this as a key level. I'm going to start off on the daily time frame, and I'm going to chart any of these macro levels that appear to be respected or relevant. I can see here, we have a key level at 130.5. That's another level I'm going to include in my chart. Maybe here, I have a level here at 114, 115. Well, because this level is so far away from where it's currently trading at, I'm going to omit it from my chart. Okay, so let's go. What else do we see here? We have a level here at 170, right? Is that a big level? Yeah, it's a big level, but it's too far away, so I'm going to exclude it. Anything else? 126 is a bit far away, but I'll include it. And then we have a big level here at 137, daily level. You can see it. Look at the respect coming in at 137. 137, almost 137, 137, 137, 137. In this case, right, because this level is almost perfectly 137, but goes a little bit down to that 136, I'm going to consider 137 to 136 a very big daily demand. The reason why is because I have two different, right? I have a wick high and a wick low over here, right? So I have to include that whole zone as my demand zone, right? That's just the demand. Demand just equals an area or zone of support, right? So now I'm going to go to the 4-hour time frame, and I'm going to see here, well, what do I have here? Well, I have a level here on the 4-hour time frame very clearly at 140. You guys can all see it, right? Look at the respect. 140, 140, 140. You can see how beautiful the consolidation is at 140. And you could even argue to me that this extends from 140 all the way down to about 139.60. Okay, so that's a key level here on Amazon. Now you could also see that my daily level was charted at 146.60. But you could say that, well, listen, that's a nice level, but it's not perfectly lining up with my 4-hour high. So what I'm going to do now is I'm going to adjust this 4-hour high and make it a little bit lower. So I'm going to take my resistance and move it down ever so slightly to account for these wick highs, right? Because I want to make it as accurate as possible. Now, on the 4-hour time frame, is there anything else here I can see as support or resistance? Well, in this case, I see a level here at 126. I'm going to adjust it properly so it's there exactly, because this was a daily level. Now it's adjusted to a 4-hour level. Everything else I love. You can also see here, look at this consolidation here between 130.5 and 131.60, right? You can see here, oops, you just went to the wrong screen. There you go. You can see here that we have a big level here, right? A big zone here. You can see, look at the interaction in this area. Can you guys see this interaction? You guys can all see it, right? This interaction is exactly what I would consider to be demand. The reason why is because you have lots of different wicks and interactions occurring in the same vicinity within $1. And in that case, I'm going to consider that a very big pocket, a very nice pocket of demand, right? And this is what I'm doing all on the daily 4-hour. And now I'm going to jump to my last time frame, which is the hourly time frame. And then I'm going to see here, is there any other levels I'm missing? Well, maybe there's a level missing here. Right? You can see that we have a little bit of a level here at 143, a little bit of a pivot. So now you know that if you're charting this, right? If you're charting this chart, this is what I was looking at during the pre-market session from Friday. You guys know exactly what we talked about in the pre-market session Friday. We said, well, listen, if we get under 143, if we get under this 143 level on Amazon, right? If you get under 143, break, retest, this could go down to 140, right? But then once we get to 140, can we be bearish anymore? Absolutely not, right? The reason why is because you have a very big pocket of demand sitting here at 140. So we know that in all likelihood, it is more likely than not that we react off this big demand zone, right? Just like this demand zone, just like if we came back into 136, it is more likely than not that we react to seeing a little bit of upside off this level. Now, I'm not saying that we're going to see, all the way back into all-time highs, but I am saying it's very likely that we're going to see some short-term reactions or short-term buying off of this key demand zone. And that's all we are. Right? In reality, I am just a supply and demand trader. You guys, 99% of you guys are as well, right? We're just trading key tactical levels, looking to scalp stocks off these key tactical levels. In essence, this is also just a larger time frame break and retest for a move higher. And what ended up happening here on Amazon is it came exactly into our 140 level, right? It came exactly into 140 level. You could have also shorted it, right, until it got there, but it came right into 140. And then as soon as it came to 140, that's when we bought calls and we saw a nice little upside scalp off of it. Now, granted, it wasn't a huge scalp, right? But from 140 all the way to around 140, 150, that's $1.50 move on the options, right? And that's on the option chain. You'll catch, on zero to D, this move, right? This move on zero to D was probably, I'm gonna guess, maybe 100% plus, right? On next week contracts, this was about, I think, 20 to 25%, right, in total. That is a great move when it comes to scalping. But you guys can see that's not the trade here is not the point. What is the point is the process of how we went from the daily to the 4 hour to the hourly to the 15-minute and to the 5-minute, right? The 5-minute, 15-minute are just used for execution, right? So we just use that to actually monitor the trade and execute the position. But you can see, right? This is how you trade, right? You start off on those larger time frames, you identify those key tactical levels, and then you execute off of these on smaller time frames. Does that make sense? I know it's a little bit of a longer rundown, but is that making sense? Okay. Awesome. Very good. How do you determine pre-market to be what the open might be? J-Rod, I'll answer that in a minute. Let me just go through a few more of the Q&A stuff. There's a lot of you guys going over stuff. Can you go over Tesla? Yeah, Mike will go over Tesla for you. What is your favorite way to backtest a strategy? Allison, this is the best way to backtest a strategy. What you guys should all be doing, right? What you guys should all be doing. And let me do this for a second. The best way to backtest a strategy is to do exactly this, is to create a morning watch list. Just like I do, just like Unraveler, Mike, Felony, Aristotle, right? What you want to do is you want to create a morning watch list, create a rundown. So for me, I was watching Amazon 140 bounce and Tesla 280 breakout. What you got to do, right? To be a real trader in the long run. If you want to be a real trader, create a plan in the morning, write down scenarios, right? What you think the market's going to do today and how you're going to react to it if it does that, right? So for me, if I was watching SPY and this was on a Friday, right? Let's just say I was watching on a Friday. Well, my scenarios are this, right? My scenarios are on a Friday. I think the biggest scenarios are, okay, well, we gap down, right? We gap down into demand. Well, if we gap down into demand, well, there's two scenarios that can happen here. We could either break down and see much lower in the market today, or we can either see a break and reclaim over 449 for a big upside move back into these previous day highs. Those are the two scenarios. And what you want to do is you want to write these scenarios down and write how you're going to play them. Well, you can say break and retest above 449 for calls, or a break and retest below 448.50 for puts. By doing this, you're creating sort of accountability, so that when you come in at the end of the day and write down what you traded and you compare it to what you were planning on the day, you're going to be inherently backtesting your strategy because you're seeing if your analysis was right or wrong, right? By going through and making a morning watch list, right? Putting the stuff that you're watching and comparing it to what actually happened at the end of the day, you are in essence backtesting. So that's the first way to backtest. The second way to backtest is to go back on TradingView and go back to, let's just say, the hourly time frame, and then go back to a random time, right? Go back to a random time. Go to the replay mode, go back to a random time, and say maybe over here, and then try to play out, right? What do you think is going to? Obviously, you kind of know what's going to happen in hindsight, but go through the chart and see what you think, right? What are the possible scenarios in the hourly time frame here? Then go to the 5-minute time frame and see how you would have traded it and see how it would have panned out if you traded that strategy. So there's two different ways to backtest. You can either use the morning watch list approach, or you could use the replay feature approach. They're very good ways to backtest. The third thing, which you could do, and this is completely separate, is you could paper trade. You could use a demo account. You can paper trade. You can play around and test strategies in real time, because obviously, like if I'm going back and using the replay feature, I kind of know what SPY did. I kind of know that it bounced off this level and then sort of trended lower, right? I kind of know that already. So what you could do is you could literally just go to current time, right? You can go to current time and you could say, well, you know what? I want to paper trade today or paper trade this week and see how you do paper trading. That's a good way to back test as well. It's kind of like forward testing, right? Let's see. Any other questions? I want a brief lesson on supply and demand. Benjamin, I think we already answered supply and demand, so I'm going to skip that one. But we can go over supply and demand again if you guys want to. I want to go over some more current questions. Can you go over volume, how to use it? Absolutely. Great question. Can you go over volume, how to use it? So that's a very, very good question. Well, what I want to talk about is volume. So let's talk about volume for a second and how you use volume. A couple things. The first thing I do when using volume is I don't like to be counter trend against volume. So, for example, on Friday, what you could have noticed on Friday, around 11 o'clock, right, around 10:50, 11 o'clock, what I would have noticed about volume here is that you can see that when we are trending lower, right, we're seeing aggressive sells coming in the volume, right? Something I like to look for is if I'm going counter trend or looking for a bounce trade, I want the volume to be sort of coming down and descending into my zone, right? That's the first thing I want to see. And the second way I use volume is I use it for rejects, right? So if I'm watching for a reject on SPY, I want to see the buying volume descend as we're approaching into my demand, into my supply, right? Two ways. The third way I use it is I use it for break and retests. And this is probably how I use volume more than anything, right? And this is how I use volume more than anything. So let's just say, for example, I was watching a break and retest on SPY. Let's say, in this case, this would be a nice break and retest, right? If I was watching SPY under this support, right? The support level here, in this case, right? So right over here at this 447, let's adjust it to around 447.50, right? Let's just say that was my level. Well, in this case, what I'm going to do is I want to wait for one aggressive sell candle, high volume sell candle under my level. Now, when I see an aggressive sell candle with high volume and large range, this is what I consider to be indicative of continuation. So if you look at this chart in real time, right? If I see a candle like this, a candle breakdown under a key support with extremely high volume like this to me is indicative of us going lower, right? So how do I trade this? This is my confirmation. So what I'm going to do is I'm going to look for a potential put entry to the downside. So I'm going to look for a pushback into my resistance, which in this case was this previous day low, which is 447.60 for a move lower. So all I'm going to do now is I'm going to analyze the volume as we progress. So let's just say next candle, right? What's next candle? Next candle is a move down, but then a slight pop up. And then the third candle, which is right over here, there, right? This third candle right over here. Notice the volume coming in here, right? This volume candle would have given me, right, confirmation that I can go short and I'm not worried about it. And the reason why is because we have a high volume sell candle followed by a low volume buy candle. This to me is not indicative of us breaking and reclaiming, right? If I want to go short on a stock, right, I want to see a very aggressive sell candle under my support. Then I want to see us pop back into that resistance level, that support term resistance on very low volume. In this case, we have horrible drawing, but you can see here, we have that low volume, right? That low volume is supported by these two smaller green candles. That's how I use volume. I use volume to help me gauge the sentiment. Now let's just turn this away for a second. If I saw a very aggressive sell candle, right? And then all of a sudden we saw an even more aggressive green candle come in, right? Buy candle. Well, in that case, I'm going to take my hands off the trigger and I'm going to wait on getting in the position. The reason why is because we have more buyers coming in than we did before, right? So the volume, right, just represents transactions. When you have a large number of transactions occurring when it's coming down, right, that's indicative of us continuing down. But then if all of a sudden you have an influx of buyers coming, you see a big green candle come in, well, that means buyers are stepping in very aggressively, and I want to be I want to be risk off. I want to be just wait to see what's going to happen. I don't want to jump in immediately. So that's how I use volume. Is I use volume to watch as we're approaching key levels. I want to see descending volume as we're approaching it for a move lower or higher. I also want to see volume aggressive breakdowns in the volume, and then I want to see the pullback to be on lower volume for us to trend lower. That's how I use volume. I know it's a little. This is a kind of this answer that I'm giving you is kind of like an advanced answer. So I hope that it didn't just confuse the hell out of you, because I know it might have to some of you. And trust me, you're not the only one there. I promise you, there's probably 150 people that are confused right now, equally confused as before. So what I'm going to do is I'm going to send you a video on price action analysis, because we did a class on price action analysis, which I think will really help you understand everything I just said in the last 5 minutes. But was that helpful? Was that a little bit helpful? I know it was a little bit Juan, sometimes we can get faked out. So Juan, that's exactly how you avoid getting faked out, right? You're never going to be 100% avoiding fake outs. There's going to be fake outs left and right. I get faked out all the time, right? But how can you prevent fake outs? Well, the best way to prevent fake outs is by reading volume, right? If you, for example, are taking a breakout, right? And let's just say the breakout pops up and you notice that these are the last couple of candles. This is one candle came in, this is another candle right over here. And you see the breakout candle, and this is the breakout candle, and maybe it's over here. Is that indicative of us blasting off and going to the moon? Absolutely not, right? What I look for to avoid getting faked out is I look for volume to support the move, right? So I'm going to look and see, well, is volume supporting my breakout? I want to see a very aggressive volume candle coming in as I'm breaking above a key tactical level of resistance. And the next thing I do as well is I also monitor, right? There was a case on Tesla, right? I'll go over Tesla in a second. I also monitor the size of the breakout. So sometimes you'll notice that a stock is breaking out, right? And everybody's like, hey, Brett, Arav, Mike, Aristotle, Felony, NVIDIA is breaking out, right? NVIDIA is breaking out. Let's get in calls. It just broke above 433. That's our resistance. We can look to go long. And we're sitting and we're being patient. And the reason why we're being patient is because we want to be sold into the position. And what I mean by that is sometimes you want to see it really break out above your technical level resistance. The reason why is because the larger the breakout, right? That larger the breakout between your technical resistance and where it's trading at, the more likely it's going to continue and go, right? So sometimes waiting there, being patient, watching that breakout, watching the volume form over the key tactical level, it's going to help you confirm the trade, and then you can get in and go long, right? But a lot of times, in fact, probably a good 40% of the time, a stock is going to break over a key tactical level. It's then going to fail under it, right? And why is it doing that? Well, it's because there was not, either one, there was not enough volume, or two, it wasn't a big enough breakout to support the move. And that's why it just kind of got faded into. There was a case on Tesla where this happened. I believe it was on Thursday. Maybe not, right? Maybe it wasn't on Thursday. I forget which day this occurred. I believe, I can't remember exactly when this happened, but the idea here is that there really wasn't, it really never broke above even on Wednesday, but even on Thursday, right? Even on Thursday, you could argue to me, right? Look at this breakout for a second. If I were to go back to Tesla's chart over here and say, well, would you go long here? Let me remove this zone. If the stock broke above 275, would you go long? Well, the first thing I would say is, well, the volume is nice, right? This is nice volume. I love this volume, right? We have uptrending, ascending volume as we're breaking above our key technical level. We have momentum starting to increase as we're pushing above the level. I like this. This is starting to look good for me. But the issue for me on this chart in particular is not the volume. In fact, the volume gives me a big check mark. What doesn't give me a check mark is the actual chart itself. Look at the breakout over 275. Is this considered a strong breakout yet? Is a 26-cent breakout over 275 considered a strong breakout? I know you guys are probably going to be biased to say no, but you're exactly right. It's not a strong enough breakout. So what we need to look for here is we need to look for a big juicy candle over 275, pushing 276 plus, right? 276 plus. Then when we see that, then we can go long at 275. We can look for the next, what we'll do here in this scenario, right, is a way for it to push above 276, right? Maybe 276 and change. Then we'll buy into that next pullback, right? Then we can get in for a move higher. But because it didn't really do that, it's kind of it's just a gamble, right? You're just kind of gambling here. We have no idea if this is gonna go, right? And that's why for me, like what I do to avoid breakouts or to avoid getting faked out in breakouts is I literally just wait there and analyze the price action, both the volume and the chart, and make sure I get two check marks: check mark on the volume and check mark on the chart itself. And if I do lose in the trade, if I do get two check marks and lose in the trade, well, that's okay. It's going to still happen sometimes. People often get very emotional when they take losses. I took a loss on SPY on Friday. We all took a loss on Friday. Still a trade I would have taken 10 times over. Is that going to change my strategy from one loss? Absolutely not. So the idea here is that every time you take a trade, try to look for these two check marks when it comes to analyzing breakouts. And if it doesn't work, it doesn't work. It doesn't mean the strategy is flawed. It just means in that one sample, right, it just did not work. So in this case here, wait for the next candle here in Tesla, and you see that the next candle was just kind of a fake out, right? This was just a beautiful fake out, faking people to go long over that key level, getting all the retail traders to go long, and then it just dumps under it and gets you short and gets everybody stopped out. The best way to avoid getting caught in fake outs is to really hone in and analyze the price action on that breakout. Okay. Sometimes you guys go on the breakout, not the retest. What's the difference? I usually go in on the retest. So what I'll do is I'll wait for a big breakout candle. And there are some times where the breakout is so aggressive and so beautiful where I will get in calls in the breakout and then I'll look to add on the retest. But 9 times out of 10, 99% of the time, I'm going to wait for that big breakout, then get in on the retest for the move higher, right? I don't really want to be getting in on the initial breakout. I'd rather get in the breakout, then get that retest for a move higher. Now, I don't always get in at the exact retest. If I was watching for a 275 retest, maybe I'd start scaling at 275.50, right, for the pullback entry, maybe add more 275. But the idea here is that if you are a new trader or a developing trader or someone that's just getting started, you don't really want to be taking breakouts. You should avoid all breakouts whenever possible. You should only be taking break and retests. Breakouts are a very, very quick and easy way to lose money because there are many times where a breakout looks so beautiful and then all of a sudden it wicks down and then it created the fattest reversal candle pop impossible, right? And then now you're stuck in the position with the candle looking like that and you're sitting there with your pants down like, what the heck did I just do, right? The best thing you can do as a trader, especially when it comes to developing trader, is just avoid the breakouts. Go for the retest, right? It's okay. You're gonna miss some trades sometimes, but it's better to miss the trades than to be caught with deer in headlight situation. That's my view. And it's totally up to you. You could take what I'm saying and throw out your nearest window, but just my belief, just showing you guys what I would do. Vic plays trade on the retest the 5 minute or the 1 minute. Vic, I use the 5 minute time frame. So the 5 minute time frame is what I use for breakouts and break and retests. Okay. We have a lot of questions. Holy Moses. 93 questions now. Guys, I don't think I'll be able to get through every question today. There's so many questions. But I'm trying to go to the big ones. What 3 indicators to use in TradingView? The 3 indicators to use in TradingView. You want to keep your life as simple as possible, right? Use 3 indicators. Use VWAP, volume weighted average price. Get rid of the lower band, upper band, and band fill. Right, remove that. Add volume. Those are the two. These are the 2 most important indicators to have in your chart. Volume and VWAP. Those are the big 2. Everything else is additional. Everything else is sort of supplementary. You don't need anything else. You could literally get away with having 2 indicators, volume and VWAP. Nothing else is really important. You could have volume to read price action and VWAP to gauge sentiment. So if we're above VWAP for bullish and if we're below VWAP for bearish. And then the 3rd indicator you can add is going to be a moving average of your choice. What I would suggest doing is using a larger moving average, like the 200 MA. And you're going to notice that the 200 MA has a lot of respect. So you could use the 200 MA as your 3rd indicator, and that's all. It's literally, if I were to say the 3 indicators to use, volume and VWAP as almost mandatory, right, for me at least, and then add one other indicator, whether it be the volume MA 200, right? 200 MA, or you could use your EMA clouds. One of the two, you could use both if you want to. But you'll notice these are the only 5 indicators I have up, right? I have a daily moving average, I have a 200 SMA, I have VWAP and volume, and that's all you really need. You really don't want to overcomplicate things. Ray Benedict, do you guys enter in the money for calls and puts? We always enter slightly out of the money or at the money. So let's just say this is the option chain, right? You have, well, let's just make this a bit better. Let's make this cleaner. Let's just say this is the option chain. You have calls over here and you have puts over here, right? Puts over here. This is the option chain. And let's just say you have the 99 puts, the 100 puts, the 101 puts, and the 102 puts, right? And over here you have the I don't know, let's just say here you have it's 103, 104, 105, 106, right? Technically this should be inverted, right? This should be upside down, but that's okay. Let's just say the current stock price is at 104, right? If it's at 104, what I'm going to do is probably go to the 105 or 106 calls. And then for the puts, I'll be probably in the 103 puts, right? So you're going to be either a little bit out of the money for puts and a little bit out of the money for calls. Same thing, right? You're just going to be a little bit out of the money, but as close as possible to the money for that trade. A little bit complicated there, but just try to keep it as simple as possible. Okay. Juice, could you go over your view up settings again? Yes. My view up settings are very simple. I just have this on my view up settings. Oh, can it let me fix it? For some reason, it's not letting me press it. Not sure why it's not letting me adjust this right now. Oh, there you go. Okay, cool. So VWAP enabled, and then everything else over here is disabled. That's all you need, right? Simple as that. Keep everything disabled and just have VWAP enabled. All the band fills I have removed. Okay. Yeah, TY, the closer you are in the money, the better. Yeah, well, the closer you are to at the money, the better, for sure. What are your 3 indicators? Okay, we went over that. How can you understand market data that will affect market price or action? Very simple. What you guys should all do is you guys should all use a tool called Econoday, right? Econoday. And what you're going to do here is you're going to look at all of the data events that have a big star next to it. This big red star, right? That little red star. These are data events that are going to impact the market the most. So if you want to go through and review what you think is things that are going to move the market the most, go to Econoday and look at the ones with the big stars next to it. So you know that housing starts and permits, that's going to have a big impact on the market. You know, the Fed chair press conference is going to have a big impact on the market. You know that the jobless claims on Thursday, these are all big market moving events that obviously are impactful because they have that big star next to it, right? That is what I would recommend doing. Okay, back to TradingView. Any new questions? Let's see. How do you find consistent areas of support in higher time frames? Zoom user, we went over that already. I can go over that towards the end. How is your process for getting trader tax status or taxes? Dave, it's a very easy process, but you have to have your CPA apply for it. So if you your first year, so if you are in year 1 of trading, year 1, right? You shouldn't be worried about, in my opinion, you should just be worried about getting profitable, building consistency. Then your second year of trading, if you have that consistency and profitability, then you should go for trader tax status. So it's called TTS. This will save you a shit ton of taxes. But it is only beneficial once you have reached that point of profitability. Many of you guys are already kind of at this point, so I would suggest reaching out to your accountant and asking how you can get TTS. The way to get it is if you have enough volume, right? So you need enough volume of trades per year, and you also need to have, it's called a substantial amount of your income comes from trading. So for me, I got TTS in my 3rd year of trading. It took me 3 years to get TTS. My 2nd year of trading, I was a little bit late to apply. In my 3rd year of trading, I did get TTS. And so for my third and fourth year, I got TTS. But it's not a requirement. It just helps you save money in taxes because you can get more write-offs during that tax year. Okay. Any new questions? Let's see. How do you calculate win-loss ratio? Great question. Amazon. Let's go over Amazon for a second, win-loss ratio. So let's just say here, right? These are two trades I had taken on Amazon. I went long on Amazon at 143, right? On Thursday. And then I went long on Amazon at 140 on Friday. In this case here, how do I calculate my risk reward here based on the chart? Well, what I can do is say, well, fine, if I'm getting in calls at 140, let's just say I start scaling a little bit earlier. I'm on 140.5, right? 140.5, I start scaling in calls. And my stop loss is under, let's just say 140 exactly. Well, I know my risk reward is going to be getting in calls 140.4, stopping out at 140, and my take profits can be back in that previous structure. So I know this is my sort of risk reward in the chart. And what I can do now is I can use a tool in TradingView called long position. So you'll see here on the left-hand side, you have long position for call entries, for bullish entries, and you have short position for your bearish entries. In this case, what we're going to do is we're going to use a long position. If I can click on it properly, long position. And then we're going to adjust this. My target is where I want to sell. So 140, 150, that's my target. My entry price is 140.4. That's where I'm entering. My stop loss is where I'm stopping out at, obviously. So my stop loss is under 140. And what I can do is maybe say one tick under 140. So I'll just say 139.85. So now I know that my risk reward in this trade is the green box being reward and the red box being risk. So in this case, I have a risk reward of a 1.95, meaning my reward is almost 2 times larger than my potential loss. So I'm risking 55 cents and I'm gaining potentially $1.07. That is a very easy way to calculate your risk reward on the chart. And for me, always, if I don't have at least a 1-to-1 risk reward, if I'm looking at the chart and I don't have minimum 1-to-1, ideally you want to have 1-to-2, but if I don't have minimum 1-to-1, then it's probably not a good trade. So if I'm risking, 50 cents to only make 50 cents, that's 1-to-1. I'm fine with that, but anything less than gaining 50 cents is going to be not a positive risk reward, right? And in that case, it's not really beneficial. Cade, what percent of your account do you risk per trade? So, okay, I trade with about a 70K account, right? So I trade with about 70,000. Personally, it doesn't, what I risk doesn't matter, but 70K is what I trade with. So if I'm risking 70K and my size is about 10% per trade, that means my average size is a $7,000 position. In this case, which would be my full size. This would be my full size on a heavy trade that I love, right? 7K. In this case, my size is $7,000. Is that my risk? Probably not. My max risk on this trade is probably going to be, on average, about 20% of that 7K, right? Because that's going to be my average stop loss on most trades. In that case, my max risk on a trade is going to be 7,000 times 0.2, which is $1,400. So my max loss on a full size trade is going to be $1,400. Now, if you wanted to change this for yourself, all you would have to do is say, well, what is your account size? Well, if your account size is let's just say 10K, right? If it's $10,000, then all you're going to do is you're going to say, then this would be, right? This would be $1,000, right? This would be $1,000, and this would be $1,000. And your max risk would be $200, right, per trade. That is how you calculate your max loss on a potential trade, right? It's always a good, you want to know how to feel better in a position is you always know what your maximum loss is, or you always know at every given point what your maximum loss is. You're never going to be stressed out because you're uncertain what your maximum loss is. You always are aware and cognizant of what your maximum loss can be. And that's going to make you feel more comfortable in a trade. Okay, let's go over how does stop loss work when a stop gaps down. Sean, your stop loss does not work when a stock gaps down. Unfortunately, if a stock, let's say you're in calls, right, and it's going down, and then let's say you're down 20% right now. If it gaps down the next morning, opens over here, there's no way to get stopped out in that after hour session. So you're shit out of luck, right? That's the way to put it. That's why swing trading can be very difficult. You've gap ups, you've gap downs, and it's impossible to stop out in between those trading sessions. Okay. Can you go over Fibonacci? Yes. So let's just say I'm watching Amazon bounce, and I want to know, where can I go long on Amazon? Well, what do I do here? This was one of the reasons why I went long on Amazon. I said, well, I like this 140 demand because we have demand here at 140. Well, the way I use Fibonacci retracements is I look to find a trend in the market. So I will find a trend. I have two trends here. I have a trend here from high point to low point. That's one high trend. That's one uptrend. And I have another individual trend here from low point to high point. These are two different trends I can work off of. This would be a smaller term trend, and this would be a larger time frame trend. So what I'm going to do here is I'm going to identify, right, my low point, my swing point, to my swing high. In this case, I used my shorter term trend because for me, when I use the hourly time frame, I like to only go back a couple of days. In this case, I'm going back to about mid to kind of like August 23rd and change. I didn't want to go that far back. You could have technically gone that far back, but for me, I focused on this one individual trend, and I noticed that my 38.2% retracement lined up perfectly with my demand zone here at 140. So the way I use Fibonacci retracements is I use it almost always on that hourly time frame to help me find and pinpoint areas where I can go long. I will use primarily the 23.6 and the 38.2% retracements. And then what I'll do is I'll look to see, well, okay, I use the 23.6 and 30.2, but does it line up with one of my demand zones? Well, in this case, I have a level here, 23.6. Is there a demand here at 142.60? No, there's nothing there, right? There's nothing there in that vicinity. So I'm not going to include the 23.6. But I did notice that 38.2 lines up perfectly with my demand zone here at 140. And that was my bounce area for Friday, is because we had that 30.2% retracement combined with that demand zone. So that's what I do. That's what I look for. I know that was probably a not so good answer, but there's no other way for me to put it. That's how I use it. I know it's a little bit complicated, but hopefully that does help. When entering a stop loss, does it matter percentage over price amount? Natalia, what I would say is stop losses are based upon not the percent amount. It's based upon the contract price. So if I'm getting in calls at 1.00 and I want to set a 20% stop loss, I know that the contract stop loss or stop limit has to be 0.8. So it's based upon the contract price. So this would be 20%. Unfortunately, with Thinkorswim, you can't just say I want a 20% stop loss. You have to physically input 0.8 would be your stop loss, which is 20% of which is 80% of 1.0, right? Hopefully that makes sense. But yeah, I use contract amounts for stop losses. Solomon, good question. I don't have the Greeks in front of me right now, so it's hard for me to answer that. But there are two things I look for with options. The things that matter to me are delta and theta. Delta represents how much those contracts are going to move on a per dollar basis of the stock itself. So if the delta says 0.55, right, 0.55, and Tesla's at let's say Amazon's at 140. Well, I know that if Amazon goes from 140 to 141, that the option contracts are going to move $55 in that $1 move. Now, if it goes from 140 to 142, right, the delta is telling me that for a $1 move, it moves $55. So in that case, that's going to be 55 times 2 equals 110. So I use delta in that way to help me find out how much the option contracts are going to move. The second way I use Greeks is I look at the theta value. Theta value represents the amount of decay the contracts are going to incur on a on a per day basis. So if the theta amount represents 0.2, if it says 0.2 in theta, that means that every day, if the stock price stays exactly the same, these contracts are going to be worth $20 less each day. So if I'm a swing trader, I'm focused on the theta value. If I'm a day trader, I'm looking almost entirely on the delta value. So the only two things I look at are delta and theta. Everything else for me, it's kind of just overcomplicate stuff. I think I like to focus on charts. I think if you start focusing on Greeks, you're going to get you're going to become very twisted, and you're going to be like, what the heck am I doing? So I recommend not looking at Greeks. It's just going to kill you. It's going to get you like all worried about stuff that you should be worried about. Okay. Is your account still the same? 10%? Is your risk still the same? 10% of your account on a Friday? Shakila, what I recommend you do is, I'm going to answer your question, but there is a video I made on how I adjust my risk on a daily basis. So for me, on a Friday, I might be trading only 3K position, but on a Monday, I might be trading a 7K position, because it all matters about the days until expiration. If I'm trading 5 days to expiration, I'm going to be full size. I'm going to have a 7K position probably. If I'm trading, I don't know, maybe 1 day to expiration, then I'm going to be probably in the 3 or 4K range, right? It's for me, it's always dependent on 3 factors: days until expiration, my confidence level in the trade, and my performance in the day. On Friday, I took a 7K position on Amazon. The reason why I had $7,000 in Amazon was because I had next Friday expiration. If I was trading that day expiration on Amazon, I probably would have had a 1K position or maybe a 2K position, right? The idea is you're always going to be adjusting your size based upon the contract's days until expiration, your confidence level, and your performance of the day. Now, I made a video for you guys on how I adjust my size on a day-to-day basis. I recommend you watch that one, because I think it will provide a lot more value than what I just said in my answer. Okay. Can you get the Blue Bread? Absolutely, you can get the recording to this. No worries. I'm gonna post the recording. Okay. People are fighting in the chat. Why are you guys fighting? Don't fight each other. How often do you withdraw profit? Shakila, I withdraw my profit on a monthly basis. Some months I make less, some months I make a lot. So for me, 1 month I may pay myself, I don't know, just a little bit, right? But some months I may pay myself a lot if it's a great month. You know, for September is my smallest month usually. So usually in September I pay myself just a little bit. Some months I can pay myself a lot. Some months I can pay myself very little. So what I always do for me is I trade on a 50K account typically. And for this month I started at 50K. Right now I'm at like 70 something. So what I'm going to do is pay myself that difference. So if I finish this month at, let's just say 85K, right? Then what I'm going to do is pay myself the difference. Let's just say you guys are taking a smaller account. Let's just say you're at a 5K account and you want to pay yourself. Well, how do you do this? What you're going to do is at the end of the month, if this account's at 8K at the end of the month, you're going to pay yourself that 3K difference, and that's going to be your money in your pocket, hard cash, right? I recommend you pay yourself on a regular basis. Now, I did not pay myself for the first 1.5 years of my trading because I sucked. Simple as that. I sucked. Like I didn't make any profit for about a year. After a year, I then started to make money. It took me about 5 months to really have an account size to surpass 25K. Then I started making money. Then after that, I started paying myself. But for most people, what you want to do is after you start, generating profit and making money, pay yourself on a monthly basis. Make it consistent, right? Do things consistently, right? Because if you don't pay yourself consistently, you're not going to respect your trades. You're gonna come into the market as if the numbers you see in your screen are fake. I don't know if any of you guys kind of have this feeling, but when I was kind of when I don't pay myself, it kind of becomes like a game. And I see the numbers on my screen and see the numbers on my brokerage, and it doesn't really feel real anymore. Don't do that, right? Pay yourself. If you have gains on the month, pay yourself. Don't be the one that doesn't pay yourself, right? And if you don't want to pay yourself, take the money and bring it to a different brokerage account and make it a long-term equity account. Much better to do that than to not pay yourself. Okay. Um, yeah, whenever it's digital, Sean, it doesn't really seem it doesn't seem real. Vic, one thing I recommend, you guys want some information, is if you, for me, like what I do now is if I have extra money, right, and I'm gonna pay myself at the end of this month, if I want to get returns my money, and I don't really want to put it in long term right now. If I don't want to move anyone to long term right now for whatever reason, put your money into Webull. Webull right now is paying 5% interest on money in your sitting in your brokerage account. So if you have 5,000, 10,000, 20,000, whatever it may be, throw that money into Webull, right? You're going to be collecting 5% interest on this money. It's better than sitting in your savings account, which gives you probably 0.01%, right? Webull is offering you some money. I recommend going to them. Robinhood also offers like I think it's 4.8%. I think Apple is around the same, but Webull I think is providing the most right now. That's per ACE? No, it's annualized yearly, right? That's 5% on the year. So let's just say if you put it's not a lot, right? If you put 100K in, right, that means that at the end of the year you're collecting 5K in interest rate payments. So if that's 5K divided by 12, that means every month you're getting $416 a month in interest payments per month on Webull if you have 100K invested. It's not a lot of money, but it's better than it's sitting in a savings account collecting dust and cobwebs, right? The better to be there, at least doing something for you. Okay. It compound. Yeah, Caesar, exactly. It also compounds. You're exactly right. It's monthly compounding. You're exactly right. Long-term equity account is in shares in Amazon or Apple. Lewis, you're exactly right, Luis. Amazon for me, I'm heavy in Amazon. I actually shifted out of Apple about 3 months ago, and I'm really happy I did. I think there's a big shift. I think there's a big shift in Fang right now. I think Fang is really going more towards Amazon, but I love Amazon. Apple always will. I think those are good companies to be in long term. Luis, long-term equity plays. What I would say, dollar cost average into VU, dollar cost average into VU. Get as much money as you can in VU over time. Try to get in as close as possible, $400 a share. That's the best advice I can give you. Other companies are invested in Amazon on dips, not at $140 a share. It's ridiculous. I would say try to get as close to 130 as possible. At this point, a lot of things are overvalued, to be honest with you. I think a lot of tech is overvalued. So I would say, be patient, sit on cash, get ready to dip buy VU if you can. Get ready to dip buy Amazon if you can. Other companies I would say is maybe Apple. Apple is weak, and I think there's still rotations out of Apple. I would say look to buy Apple around that 160 area. I think 160 to 170, if you can get it around there, I think that's a good average for the long run. All right. Thoughts on banks long term. The issue with banks, Vic, is that there's always going to be regulations that impact them. I would say the best banks to be in are going to be Morgan Stanley, MS, and GS. MS, GS, and JPM. Those are the three banks you can't go wrong with. You can pick a mixer of three and look to get in on pullbacks. Buying now would be hazardous if you can catch the IPO. I would have to say, Sean, it depends which ticker you're talking. Oh, ARM, yeah. You guys want to talk about IPOs? Look at the Hood IPO. Look at Hood's IPO, right? This is the 5-minute chart. This is the hourly chart on Hood. Guess where Hood IPO'd at? Hood IPO'd at $36. I think it's even more than that. I think this is a misprint. I think it IPO'd around like $40 a share. I think it was like 40 in the 40s. Hood IPO'd in the 40s, right? If you bought Hood, if you put, let's just say, I want to put $10,000 in Hood, right? If you put $10,000 in Hood on IPO, you are now down 72%, meaning you now are down $7,200 on your initial investment. Investing into IPOs, it can be incredibly lucrative, but it's also very, very risky. The ARM stock, I don't know anything about ARM. I don't know anything about it, right? I don't know anything about it. And I'll have to review it for you guys if you want. I can look at the fundamentals, but look what Hood did, right? Look what Hood did. Hood literally, it IPO'd at $40 a share. It ran all the way to $85 a share, right? And then now fell all the way back down to $10 a share and is now consolidating here. I'm long on Hood. I love Hood. If you liked Hood over here at $40 a share, imagine how much you like it right now at $10 a share. I like Hood right now, but look at ARM. ARM's chart looks pretty similar to that Hood chart. I don't really want to be buying into this. There's not enough data for me to work off of. I don't know anything about Hood or anything about ARM. I would rather wait for a consolidation, wait for a little bit of a pullback, then get long and buy the highs. And for me, I'm just not it, right? Unless there's something fundamentally incredible about ARM, which I don't know about, then I'm just going to avoid it. Now, I do know that they provide the infrastructure for companies like NVIDIA, AMD, and QCOM, but I don't know much about it fundamentally, so it's not something I want to put my eggs into. If that makes sense. Okay, Kava. Now, Kava is something I do like. Kava is a company I understand well, and is a company that I do like their fundamentals. And I think Kava could be setting up for a good long-term buy. Is it going to be now? Probably not. I probably want it around $30 a share, but this is something I could buy into. It would just have to be a lot lower, probably around $30 a share. I think that is where I could get a good dip buy. But you can see, like, when these stocks IPO, they sometimes do irrational things, right? So I don't really want to be caught in that irrational move. I'd rather be caught getting a pullback, even if it does rip, right? If ARM does rip, I'm fine getting it in a pullback. I don't really want to be buying into that IPO. Okay, can you talk about determining key support and resistance levels while live trading during pre-market? Could you show examples when price reaches these levels and what to look when to enter these trades? Flower Guts, that's a good question. Could you talk about determining key support resistance levels while live trading or during the pre-market? Could you show us? Yeah, I can do that. So tomorrow, I can go over that and show you what I do. What I recommend, Flower, is come to the pre-market session tomorrow morning, and I'll go over this, right? So I'll go over some of the charts I'm looking at, and how I'll adjust my sentiment based upon the day. Will AMD go under $100? Trey, I have no idea. Hard for me to answer that question. Go to the chart, AMD will go under $100. I mean, based upon the chart, it's very possible. Like, probably more than likely we do go under 100, I would say. That daily candle was incredibly weak. If we do get continued tech weakness, I could definitely see AMD under $100 a share, right? And if we do break 100, that's setting up, it's opening us up for some aggressive downside over the next couple of weeks back into 89, right? So I would say under 100 could be setting us up for a pretty incredible short, if we do get under that level. Okay, yeah, the daily volume is pretty strong, right? I mean, it was quad witching volume, right? So it is normal for us to be a little bit lower volume or a little bit higher volume, but that is a very aggressive daily candle. You could also argue, I mean, look at this daily candle, right? Look at this. I bet you, last week, right, August 24th, a lot of people would have said, oh, hell yeah, Amazon's going down based upon this candle. But we have to be cognizant of the fact that we are approaching 100. Very big demand zone. Nobody really knows, but nobody in their right mind can sit here and tell you definitively that AMD is going to break 100 or it's going to hold 100. Nobody really knows that. What we do know is that if we get under 100, we likely will see back at 89. That is what we do know. And we do know that if AMD retains 100, bases off 100, right? We see a green daily candle off 100, very likely we see a pushback in 114. We never really know what is going to happen. What we do know is if this does happen, then that will happen. If we do get above 105, we probably will see 114. If we get it below 100, we probably will see that 89 level. So very important way to answer your question is to answer it with the fact that we don't really know what it's going to do, but we do know that if it does clear 105, we likely see 114. If we do break under that 100 level, we likely would see 89, right? That is how you approach the market in that's a better way to approach how to answer that question. Because you can look and see here, look at this approach to 100, right? Extreme high volume. And the next thing you know, what ended up happening was that we just bounced off of it, right? At the end of the day, nobody really knows. But what we do know is what happens if we do hold or break under key levels. That is how we trade, right? We just react to key levels. Okay. How do you determine your stop loss for a trade? Are you going to be based on percentage or based on the sense? Okay, KP, this is my last question is going to be how you find stop losses. On bounces and rejects, how I find stop losses is I literally will go into the market and I'll say, well, if I'm watching a 140 bounce, I'm going to look for a stop loss 1 ATR under that 140 level. In this case, I'm on the 15-minute time frame. I can see here that the average size here is about, it's about $1 per candle, but that's a little bit too wide. I use the 15-minute time frame. I see there's a wick here at 139.70, and I can also see that under 140, one little volatility candle under 140 would be my stop loss. So 139.70 would be where I want to stop out. And the reason why is because it's that 15-minute level, and it's also a little bit of volatility under my key level, right? What I mean by a little bit of volatility is I just mean it's accounting for a little bit of like a degree of error under 140. So if we just sort of crack under 140 and then just so slightly break underneath it, I don't want to get stopped out. So I'm going to use a little bit under my key level, and that would be my stop out for my bounces and rejects. On break and retests, it's much more simple. All I'm going to do is say, well, okay, fine. If I'm watching for a 143 break and retest, all I'm going to do is on the 5-minute time frame, right? If I'm watching a 143 break and retest, I'm going to say, fine, well, we get that breakout, right? This would be the breakout candle here on Amazon. I'm going to use that candle low as my stop loss. The candle low of the breakout candle is usually my stop loss 9 times out of 10 on break and retests. So if I see breakout candle, I'm using that candle low as my stop loss. That is how I find my stop losses on break and retests and bounces and rejects. They're different, right? Break and retest, much more simple. Bounce and reject, I'm usually using one little degree of error under my bounce level for my stop loss. Okay, I've been yapping my mouth for about an hour now, about an hour and 15 minutes. So I want to stop now. I wanted today's session to be very short, but that's okay. I'm glad that we sat around. I'm glad that we got through as many questions as we possibly could. There's still about 115 questions that are unanswered. And I'm sorry, but unfortunately, I can't get through everything. I'd probably be here till next Monday. So I'm going to stop here. But remember, we have a class on Friday. It's going to be a nice one. We're going to have a full lecture. We're going to go through everything else. We're going to go through a nice lecture and then maybe 5 to 10 minute Q&A afterwards. So it's going to be a really good lesson. If you learned something from today's session, I really would appreciate a post. Tag us in the testimonials section. Let us know what you think. If I sucked, you can say, Brett, you suck, whatever. But if I was helpful and you learned something, I would love to hear about it. I appreciate you guys. I'll see you guys all tomorrow. We'll be live trading. Yeah, looking forward to making some money with you guys. Thanks again, everybody. Again, I'm sorry I didn't get through all your questions, but I didn't expect as many of you guys to show up on this Sunday afternoon. Appreciate you all, and I'll catch you guys all tomorrow morning. Bye, everybody.